Hey everyone, welcome to our DAT IQ weekly market update. This is our update for June 24th, 2020. I'm Ken Adamo, Chief of Analytics at DAT, joined as always by the incomparable Ned Damon, Principal Data Scientist at DAT. Ned, no guest this week. What do you think about that?
Ah, guests are a very special thing. You gotta clean up. You gotta do some vacuuming. You gotta put away the kids' toys. I'm just not sure that we're gonna be able to get that done in time for the next round. But fingers crossed.
For sure, I guess it's all on us. Do you want to hit us with the key points of the week?
I'd love to. The load to truck ratios are moving up for van and reefer, which is very good if you're a carrier. It's a little bit unusual, but still very good. Reefer MCI map is showing the peak intensity, very, very hot throughout most of the United States. Dry van rates have shifted upwards in kind of an unexpected way, while reefer is holding steady. And there's a little bit of model disagreement between what our model suite is saying about the future of dry van rates. So stay tuned and you'll find all that and more. Ken, do you want to head into market dynamics?
Yeah, and there's some really interesting things happening this week. Quite a few of them were a bit of a surprise based on what we were thinking a week or two ago. So jumping right in, dry van load board activity. So this is load to truck ratios for dry van year over year. And you can see we really saw the red line, which is this year, shoot up. And it's really now sitting right between 2017 and 2019 levels, which is good. Yeah, we weren't really expecting that kind of change this week. We dug into the numbers a bit. What we did see was load posts increase and truck posts decrease a little bit. So a bit of a compounding effect, which really drove that number upwards. If we look at reefers for a second, we saw an uptick, nothing as strong as on the dry van side, but again, it's good to see it bounce up, sort of kind of what we'd expect finishing out the last couple weeks of produce season strong heading into the 4th of July. Changing over to the MCI map here. So we have dry van. So what you'll see is the nexus of strength is a bit tighter than in previous weeks or even on the reefer side, but it's much more intense. We see South Texas, Southeast Georgia, moving all the way up into the Carolinas and kind of into the lower Midwest. Very, very hot right now, bumping up even against 100 in some markets, which is the top end of our MCI scale. Changing to reefers, the love spread out a bit. This is good, right? Last week we saw a little bit more coolness than we would have expected. And reefers can kind of be like that this time of year. Produce season's a bit unpredictable. We've talked a lot about a jagged line heading upwards, and that's just what you'll see. Some hotter, some cooler weeks. But again, really good to see very strong in all of your seasonal growing areas. Changing over to spot rates. And again, Ned alluded to it, but the surprise of the week, not only are dry van rates continuing to increase, but they're accelerating upwards. So these are the spot rates. We're now sitting comfortably above 2019 levels, 2017 levels, really kind of within earshot of the March COVID peak levels. Now, what this could be is you can see in other years the peak happened a week or two later. This could just be peaking out early and it'll come back down. It could be peaking and plateauing, or kind of could just be on the stairs all the way up. Ned will talk more about that when he talks about the models in a bit, because I think we're seeing at least statistical evidence of each of those possibilities in our models. Pivoting to long-term, short-term, real quick. This shows, I like this chart because the dotted line, which is the really short-term look, a 3-day weighted moving average, is really kind of right at the COVID peak levels. Now, we know that line's very fickle because it's such a short-term average and it could bounce back down, but it's just interesting to see where rates sit for dry vans. Looking at reefers, it's kind of been on this slower growth trajectory. Now, we will expect over the next 7 to 10 days, even pushing 14 days, to accelerate up a bit. And if it doesn't, that would be seasonally aberrant. But we're closely watching it. And if I flip real quick to the short-term view, you can see the very short-term average is starting to very much fall in line with prior years. So I think best expectation is the next 7 to 10 days to follow that 2019 seasonal trough for reefers. Now, we've talked a lot about what's going to happen in the future, but I want to turn it over to Ned now to talk really about what the math is showing us, what our models are showing us about what the future might hold in store.
Absolutely. Thank you very much, Ken. So we're moving to our dry van spaghetti chart. So this was run on 6/22, and you can see the blue line are the actual market rates observed by DAT, and then off to the right, you can see our model suite. Red is the short-term focus model. Green is the more historically grounded Ratecast model. And in the middle, we have our blended forecast that are mixtures of these two models in different ways and in different amounts. You can see that there's broad model agreement heading up until the 4th of July. Everybody at this point is thinking that it's going to be up and to the right until 4th of July about. And then on 4th of July is when the real divergence starts, with the short-term model really expecting things to continue up and to the right, and the Ratecast model expecting sort of normal patterns to reassert themselves. I tend to feel like normal patterns are reasserting themselves, both in the marketplace and overall, but honestly, there is a non-zero chance that things are just going to continue up and to the right. And it's important to be prepared for that. Moving forward to Reefer. Reefer also shows broad model agreement up through July 4th, and then there's some dispersion after that, with the Ratecast model expected heading more down following standard seasonal patterns, and the short-term model heading up and to the right, continuing the current trajectory. And one thing I will say about reefer rates is that reefer rates, because of their tie to agricultural produce, just agricultural stuff in general, tend to be much more governed by external seasonal patterns than other rates. So I would expect the seasonal structure to be much stronger for reefer than it is for others. And instead of a special guest this week, instead you have an exciting flatbed forecast. And oh boy, is it a spicy guy. You can see that there is big model divergence almost immediately for the short-term versus the Ratecast model, and of course the blended forecast in the middle, with the Ratecast model expecting this to be about the peak and things to kind of head down to a little bit lower of a plateau moving forward into August, whereas the short-term model is expecting just pure up into the right. So I think talking about all the models and kind of their structure will tee up this question really well. Ken?
Thanks, Ned. So the question that we've been getting now that Ratecast has been out in the wild for a while, it's a really simple one, right? How accurate is Ratecast? And when marketing asked me this question, my response was very, and I left it at that. Turns out that was not enough of an explanation to satisfy what our customers and partners were asking. So what we're going to do right here, is it makes analysts very uncomfortable to really kind of pull back the curtain and get into the nitty gritty. But I personally believe in transparency, and DAT as a whole is extremely transparent in how we go about things, which is, I think one of the things that sets us apart. So what I'm going to do is show something that I actually posted on LinkedIn yesterday, and it's got a lot of comments and questions, and I thought it would be really good for us to walk through it. So I'm going to walk through the simple stuff and then turn it over to Ned, who built Ratecast and is much smarter than me to walk through the heavy lifting. So what is this? This is our Ratecast report card. This is every single forecast that was ran on June 8th for our what we call use case 2. So that's the 7-day rate view rate, predicted out 35 days. Now in the UI, when you log in there, you see 8 days. What we want to do is make it a little more challenging, a little bit of a stricter test to grade Ratecast. So we actually pulled 14 days of that history. So this is the model on 6.8 for 14 days of history. We actually matched over 200,000 rate view outputs over that time frame. So predicted versus actual. And that's what you see in this blue chart. The x-axis on the bottom is predicted. The y-axis is actual. If we were fortune tellers, or we could see implicitly into the future, that line would be a perfect 45-degree. Every single prediction would be accurate. That's obviously not the case. So I'm going to turn it over to Ned to walk through how the model is performing in a more empirical sense.
Absolutely. Thank you, Ken. So I think the first thing is to just give the summary number, and that is the model is more than 95% accurate. If you just want like a little factoid to keep in your back pocket, that would be the factoid that I would go with. But to go into a little bit more detail, I think the best way to reason about this is by analogy. So if you imagine an archery target some distance away, and you imagine the bullseye being perfectly accurate, that the predicted rate was exactly what the forecasted rate was exactly what the actual rate was, then that's the bullseye. And each prediction is shooting an arrow into that target. So the first number I'm going to talk about is the forecast versus actual. So we had for this period a forecasted average value of $1.63 and an actual average value of $1.67. So if you think about the arrows, this meant that overall, on average, our arrows tended to undershoot the bullseye by about 4 cents. In general, we're better calibrated than this, but overall, that's a pretty reasonable number for the calibration. The next number that I'm going to talk about is records within the prediction interval. So if you're familiar with the UI, we give you kind of a cone of uncertainty. And this is the number of times that we were within our cone of uncertainty. And that was 73.6% of the time. So this meant that on average, we were a little bit better calibrated in our uncertainty of the predictions than we actually were, so that we were more accurate than we thought we were going to be. Now moving ahead to the next number. So if you remember the analogy about the archery target, if you think about shooting an arrow 2 inches above the bullseye and an arrow 2 inches below the bullseye, if you were to average those two numbers, you would get a perfectly accurate prediction, which is not actually true. Instead, what you want to do is you want to look at the average dispersion, the absolute error away from that bullseye. And that's a number given in the MAE, or mean absolute error. So over this period, we were about off by about 7 cents. So that was the average dispersion from the bullseye during this 14-day period. If you percentagize that, you turn that into a percentage of actual, you get the MAPE, or mean absolute percent error, and that was 4.39%, and that is where I pull out that 95% figure. And if that's all you're interested in, then that's a fine place to stop. But we also provide some additional metrics, and we have more metrics in the back. If folks are interested, we can talk about that later. And one of those metrics is the root mean squared error, or RMSE. So the reason why we look at RMSE is because frequently it matters not only how right is the prediction, but how right is the prediction in unusual circumstances. So the RMSE punishes outliers, that is, predictions that are very off more than normal. Essentially, it's looking at the square of the error. And our RMSE during this period was about 10 cents, which works out in a percentage basis to 5.87%. And 5.87% is remarkably good for an RMSPE during this period where we're still emerging from kind of the COVID peak. And I think that's one of the COVID trough. And I think that's one of the reasons why the model was undershooting a little bit, is that it was expecting that the trough was going to continue for longer. And I feel like overall the performance of the model is quite good, and I'm pretty happy with it, honestly, especially during this period. Ken, do you think that answers everybody's questions?
I do. And Ned, if it doesn't, if you have a different time period, different use case, or a specific couple lanes you want us to do this for, just shoot us a note at askiq@dat.com. We're happy to do that. And I wanted to also add, I'm really proud of the team. This is not an easy time to be doing forecasting, not an easy time to launch a forecasting product. And this effort towards continuous improvement and really being strict with ourselves and holding ourselves to a high standard, I think it's going to ultimately flesh out in a much better product as we keep iterating on it. So all that being said, do you want to wrap us up for the week, Ned?
Absolutely. I want to thank everybody who joined us this week, and remind viewers that they can find the weekly updates at dat.com/COVID-19 if you want a more text and website-based rather than a video-based version of this information. If you have questions, or if there's specific lanes that you're interested in getting our model accuracy on, or if you're interested in just more details about the Ratecast, you can email us at askiq@dat.com. You can also email that address if you want the top 50 lanes report for free. So the top 50 lanes report is looking at the top 50 spot lanes by volume, and it's giving short-term predictions and short-term historicals. Again, email us at askiq@dat.com if you're interested in that top 50 lanes report. We'll be back next week with a new update, and if we do enough cleaning up around here, maybe a special guest. And I want to thank everybody for keeping America moving.
Bye, everybody. Have a good week.